France's sovereign debt crisis just got a lot worse. Scope Ratings just downgraded French government debt, with France receiving its third downgrade in just the past 2 weeks alone, a damning indictment of a spiraling fiscal crisis and leaving France just 2 tiers away from losing its investment grade status. So here we can see 260% debt to GDP, external debt to GDP. And of course, this crisis did not develop overnight. Now, France was largely immune from the PIGS crisis, the debt crises that gripped Europe in the early 2010s. However, these downgrades go all the way back to that era of time. This is not something that just popped up overnight. Here we can see that reflected in the percent change of government debt relative to the percent change of GDP, which again is that economic output. If you can go into $1 of debt but get $3 of economic output, it's actually a really smart idea to go into debt. However, as we can see, they are getting negative return on each euro of new debt. Since 96, only 65 cents, but wait, it gets worse. Since 2000, it dropped to 60 cents, and since 2008, it is just 48 cents. So the marginal productivity of each euro of debt is falling, meaning they have to issue more debt to get the same €1 of economic output. We'll take a look at more TradingView charts, but this is a Bloomberg article that goes through, and I will link this in the description. Here is the actual rating. So I will go through this. I highlighted a couple key sections here for so that when we go through the TradingView charts, these will be fresh in your mind. So the downgrade of France's long-term debt is driven by two things. One, the moderate growth outlook is weighing on revenue and driving the deficit. We'll take a look at that in a second. But this moderate growth outlook, now moderate is a kind word, as we will see later, and uncertainties regarding timely implementation of this budget that France passed. Here, I will also link this. It can be translated into English. They had a budget proposed, or a framework proposed back in 2023 that goes all the way out through 2027, showing how they were going to reduce the budget deficit. So when they're talking about the implementation, that is what they're talking about. Of course, political issues, the challenging political outlook following they had some legislative elections, which have reduced the level of alignment between the presidency, the government, and the parliament. So remember, they have a parliamentary system, so quite different from, say, the U.S. You have to have a ruling you have to have a coalition between multiple parties. They are fragmented more and more over in France, which again means that the ability to get things done, if you think it's bad in the U.S., it's actually even worse in France. Now, scrolling down here, they talk about high fiscal deficit and the gradual, very gradual fiscal consolidation path. They say the budget deficit reached 5.5% of GDP in 2023, significantly above the target of 4.9, due to tax revenue shortfalls amid a moderate real GDP growth rate of 1.1%. So remember, revenue is dependent on growth. The government can only kind of skim off of the top, right? You have to grow the pie because the tax revenue for the government is just a slice of the pie. So you need to make sure you're growing the pie. If you're not growing the pie, the slice is going to be pretty small. So hopefully that makes sense. We'll take a look in a second, but this quote unquote moderate real growth of 1% is clearly driving a lot of this. And we'll take a look. It's actually even worse than that. So they talk about some proposed discretionary measures that are being proposed, including a reduction of tax relief for corporations, so basically raising taxes on corporations, a 6-month postponement in inflation indexation for pensions. This would be similar to the cost of living adjustment for Social Security, or the COLA, that we get here in the U.S., and an increase in energy excise duties for households. Oh, and also a pension contribution hike in the rate for local and hospital public servants. They talk about postponing the framework that we just took a look at that was translated into English. They talk about postponing that framework and that it's being postponed by 2 years And so they just kind of keep kicking the can out further down the road. They talk about the planned spending-based consolidation is expected to be challenged by increasing pressure on military expenditure, aging costs, and energy investment, alongside rising net interest. We'll take a look at the yield curve, which are set to rise from less than 2% of GDP to more than 3% of GDP by 2029. And the prospects for revenue based consolidation are constrained by an already high tax burden and a quote unquote, again, there's that word, moderate, albeit resilient economic activity. Real GDP is only at 1.1% for 2024 and 2025, which again, that is going to reduce the revenue side. And remember, the government needs the pie, the overall pie or GDP. They need that pie to grow, or their slices, their revenue is going to be quite small. And then they say, as a risk, although it's not the baseline, a stronger parliamentary opposition could attempt to unwind prior reforms, for example, on pensions. In addition, the current political environment raises the risk of political paralysis and or instability, as opposition parties in their version of Congress are more likely to successfully introduce a no confidence vote against the government. So here is the actual ratings document. I will zoom in a bit here. They talk about the budget deficit widening. We'll take a look in TradingView in a second. Again, that political fragmentation. I wanted to point out their public finance risk is quite weak. Now, this is a 20% weight in Scope's rating framework, but they only have a double B when it comes to public finance. That is quite weak, especially for a developed economy. They talk about some credit strengths and some credit challenges. Of course, large budget deficits and an uncertain fiscal consolidation path. Again, that implementation of the framework that we looked at there, high and rising government debt, growing political fragmentation and polarization, and again, that word moderate growth potential. Now, they do have a relatively long average maturity, so they mentioned that as a positive, a strong economic resilience, large and diversified economy. We'll take a look at how true that actually is. Now, here is the rating history for Scope only. We looked prior at the overall picture from various different agencies. Here's that real GDP, and we'll take a look, but look at the blue line, which shows the peer group average. It is notably higher than France. So again, growth is a critical component of a debt crisis. And we will look at the growth picture in a second. So in terms of that public finance risk, again, they have a double B rating. This is quite poor. They do talk about that favorable debt profile with a long average maturity. The reason I highlighted this, I really want to emphasize, this is the opposite of what the U.S. is currently doing, which is, and again, it started under the last administration, which is shifting our debt issuance into very, very short-term bills. So remember, if you have it spread out, that gives you a buffer. Well, the exact opposite is also true. This is one of the few things that is propping up their overall public finance rating. If they were to, be in a position like the U.S., that might even be double B minus or even a below investment grade. So it's really critical that we understand that concept of the weighted average maturity for debt. And then, of course, their net international investment position is also negative relative to their peer group average, which is relatively flat. We can see that France is negative when it comes to their net international investment position. Oh, and by the way, foreign currency denominated debt is yet another negative factor for France. And also, this one, which gets pointed out quite often for Europe, the old age dependency ratio. So they have falling demographics. So as the youth who are the ones paying the tax for, say, Social Security here in the U.S. or Medicare, which are the vast majority of government spending, generally speaking, well, if that youth, if the population of that youth that are paying the taxes and funding the elders, the benefit packages, if that population of youth is not growing, or if it's unemployed, which we'll take a look at in a second, then you have a lopsided situation where there are way more boomers that need various benefits, Social Security, Medicare, than there are people actually working to pay into it. So hopefully that's clear. Now we will look through a couple of TradingView charts I have here. Here is the yield curve. And of course, we have the overnight rate, which is at just 2%, 6 month, 2 month, 2 year, 5 year, 10 year, and 30 year. They have a notable bear steepening here. We've been pointing this out for a couple months now. You can see that over the past couple years, really, you've seen a dramatic increase in their 30-year yield as well as their 10-year yield. And to some degree, there's a bit of a twist steepening depending on when you start examining it, when you start the start point. But short-term rates are falling, again, much like in the U.S., but we can see that the curve has steepened quite significantly from June of 2023 when it was flat all the way to 237 basis points between the 30-year yield and the 2-year yield. And then, of course, there's also that when you're talking about long-term debt, that is where fiscal concerns get priced. Now, inflation is only 0.9%, so they have very restrictive rates. Their overnight rate being at 2%, and once you go further out the curve, like the 5-year, 10-year, and 30-year, those are very restrictive. The real yield there is quite high. And of course, the curve has steepened very notably. Here, we're going to look at French debt relative to peer debt and the yield on French debt versus Germany, Italy, and Greece. A couple things I want to point out. France now demands, Greece had a full-blown sovereign debt crisis just a decade ago. French debt now demands a higher yield than Greek debt. So we can see that in yellow. It is above zero. If you look at Italy, Italy was also in the PIGS crisis, the sovereign debt crisis of the early 2010s. And of course, French debt is almost higher in terms of yield than Italian debt, and they just went through a sovereign debt crisis. If we look at German debt, of course, Germany is in a much stronger position than France. We can see that the yield demanded to buy French debt when Macron took office or won the election, this spread between German debt and French debt was about 25 basis points. Well, it is now 82 basis points. So that is basically a 3x in terms of spread. Germany is quite often looked at as kind of the powerhouse of Europe and a good kind of benchmark. Now, it's important to point out, we talked about that framework that had been proposed back in 2023. This just dropped yesterday. The French Prime Minister says the austerity budget for 2026 is out of the question. So there's already kind of developments that are making it seem like it's not going to, the planned reductions for the deficit are not going to go through. They already kicked the can 2 years down the road. It is not looking good for France. So here is GDP, real GDP, just 0.8%, just anemic, very, very anemic. And look at their unemployment rate, 7.5%. Now, their inflation rate is quite low, 1%. But again, that is because of very, very low growth. Now, if we throw a 8-year moving average, over the past 8 years, their GDP has only averaged 0.79 percent annual growth rate. And look at how high their unemployment rate is. But wait, it actually gets worse. So here we're going to look at GDP per capita, per person. And here we're looking at France, Germany, US, and Great Britain. And this is adjusted for common currency, in this case, the dollar. Of course, we can see the US is about double the GDP per capita of France, which is here in white. But look at, they're lagging even Germany and Great Britain. So even compared to European peers, they are notably lagging their European peers. And if we look on a purchasing power parity basis, which again, this adjusts for the purchasing power strength of the various currencies, of course, the dollar and the euro and the pound, we can see again a very, very similar story. It's kind of right there even with Great Britain, but notably below Germany and notably below the US, of course, which has one of the highest GDP per capita and purchasing power parity. If we look at the per capita growth rate, again, it's only running at 0.8% annual growth rate. This is very anemic, and as you can see, the trend of growth, again, the pie that the government takes a slice from, the size of that pie, the growth rate of the size of that pie is falling, and it has been falling going all the way back to the 60s. So I mentioned the unemployment rate, very, very high at 7.5%, or certainly about double the rate in the US. But look at the youth unemployment rate, 18.7%. So again, that goes to that story of you need the youth to pay the tax to support the elders? Well, if you have an 18.7% youth unemployment rate, that becomes even more difficult. Again, that old age dependency ratio that we looked at earlier. Now, here's government spending on an annualized basis. This is only final consumption expenditure. I wish TradingView provided full government spending, but this is what we got. So we're taking a look. Obviously, there was a dramatic increase here in 23, 24. And of course, military expenditure is part of that, but interest is also a large part of that. So if we go back to the yield curve here, we can see that rates have been up and to the right, especially at the long end of their yield curve. So again, interest is driving this. TradingView did not have the annual interest outlays, unfortunately, so we can't look at that. But we've seen it for Germany, we've seen it for the U.S., we've seen it for the U.K. The same story is true basically across the board. Over the past couple of years, interest payments are skyrocketing. Again, going from 2% of GDP to 3% of GDP. And France is not the reserve currency issuer, so they can get away with a lot less. Here's the budget deficit as a share of GDP, and this is not actually inverted. It is normal. And then the current account as a share of GDP. Now, they generally, going back to 2008, have really ran a current account deficit, and this makes them a twin deficit nation as they run almost a 6% budget deficit. Now, in the US, it's about 6.9% budget deficit, and that is insane given that there is no severe recession or world war or anything like that. 7% budget deficit is insane for the US, but we are the reserve currency issuer, at least still, to this day we are. And so that alleviates some of the burden that should be being placed on the country, on the currency, and on the interest rates. The fact that France, again, not the reserve currency issuer of the world, is running a 6% budget deficit is just insane. I mean, you can see the moving average here, the 6-year moving average. It's just down and to the right with an ever widening deficit. And again, generally speaking, a current account deficit. Remember, this is mainly the balance of trade, but it does include primary and secondary income. I did want to note the 10-year yield, just like in the US, was declining. So you could do this. You could run large deficits as the cost of your debt is falling. However, we know that that is obviously not the case for the West over the past couple years. So going to that current account deficit, here is the current account on an annualized basis, and then the price of oil. Now, this is critical for France and most of Europe that rely on energy imports. So we can see that the current account deficit gets worse as the price of oil goes up, because again, they've had some pretty questionable energy policy over there in Europe, and are reliant. They are short energy. And they are relying on energy imports. So we can see that obviously with a couple month lag, there is a significant impact of a rising oil price on the current account. And again, the current account is one of those two main accounts you have to watch, mainly comprised of the balance of trade, but also including primary and secondary income. Here, of course, is the euro. Remember, as the strength of the currency, as the currency gets stronger, that makes your goods less competitive on the world stage. Now, I do want to point to a bit of a divergence I kind of noticed, which is going back to, say, 2013, 2014, the current account has really not has arguably gotten worse, their deficit. But despite that, if you look since this period of time, the euro has actually weakened. So there's an interesting divergence there. I'm not exactly sure. It might have something to do with oil. If we go back to oil, that had that showed a pretty strong correlation. Of course, oil has not weakened nearly as much as the euro has. And then finally, here is the dollar yuan exchange rate. Again, China, a major exporter for the rest of the world. As the euro gets stronger, well, put another way, the yen or the yuan gets weaker, or the yen, these other currencies get weaker. This puts pressure on their current account, which again strains public finances. So here's the budget as a share of GDP, inverted, right? So as the white line's going up, is getting worse. This is a more current data point than the other one we were looking at. And then FX reserves. So these are the global savings that get accumulated when a country runs, say, a current account surplus or a fiscal surplus. You can think of gold, you can think of foreign denominated bonds, these sorts of things. And what I want to point out, as the budget deficit blows out, you can see that generally that has a negative impact on foreign exchange reserves. Again, you have to finance those large current account or fiscal deficits, you have to finance them somehow. Well, one of the ways is you run down your foreign exchange reserves. This is what we're seeing in Argentina. So, finally, to finish up here, here's the average monthly wage for the average Frenchman in gold terms. And then, of course, the home price divided by the wage, the average monthly wage. We can see that home prices have actually been relatively flat for the past 10 years in wage terms. Put another way, you don't see the kind of hyper financialized, very current account driven or capital financial account inflow driven home price appreciation that we see here in the US as a result of the dollar's reserve status and our large trade deficits. You don't see that in France. If you go back to, say, 2019, the home price relative to the wage is basically flat. So, home prices, or put another way, wages are keeping up with home prices. So, generally speaking. So, hopefully, this was helpful. Again, we'll link to the various articles that we looked at, including the Scope Ratings Agency, and I will catch you on the next.